All right, good afternoon, everyone. My name's Scott Faber. I'm here today on behalf of the Environmental Working Group. I'm very pleased to help moderate today's panel on several terrific papers that are being released today by the American Enterprise Institute. We have four really deeply knowledgeable experts about farm programs and farm subsidies. Our first speaker will be Joe Glauber, who's a senior research fellow at the International Food Policy Research Institute. Joe will be followed by Barry Goodwin, who's the William Neal Reynolds Distinguished Professor in the Department of Agricultural and Resource Economics at NC State University. After Barry, we'll hear from Vince Smith, who's a professor of economics at Montana State University and an AEI scholar. And then lastly, we'll hear from Dan Sumner, who's the director of the University of California Ag Issues Center and the Drake Buck Distinguished Professor in Agriculture and Resource Economics at UC Davis. So with that, I'll turn it over to Joe.
Great. Well, thanks very much, Scott. And thanks to AEI for organizing this. One is I appreciate the opportunity to open today's session with a brief overview on the current state of the farm sector. As some of you may know or remember, prior to my leaving USDA and going to IFPRI, I was chief economist for the department from 2007 to 2014, and these were years that were characterized by very high prices, record high prices, at least in nominal terms, record exports, and record farm income. Those numbers have all come down over the last few years, in some cases significantly, but I will argue here that the indicators suggest that contrary to the claims of some, the overall health of the farm economy remains strong. Over 2007-12, we saw three consecutive price spikes, the last in 2012-13 as a result of the drought in Southern But and North America. Let me see if I can key this up. Okay, there's me. Thanks. But those record prices were followed by a sharp rebound in global grain and oilseed supplies, boosted by increased plantings and good weather. Global wheat production since that time is up 14%, corn is up 19%, and soybeans up almost 30% since 2012. And as a result, as you can see on the chart, farm prices fell by as much as 25 to 35% from the record highs. Yet prices for many commodities have both increased over the past year, and they remain but despite remaining below the peaks of 5 years ago, remain high relative to longer-term averages. Now, farm receipts, on the other hand, have increased, or have also decreased, but not nearly as much as prices. In part due to record yields here in the U.S. that have partially offset those price declines. Farm receipts are down about 20% from the levels of 4 to 5 years ago. I'm sorry? You can't see size. I have a great picture of them here. Can we do something about this? Okay, if you can only picture what I'm saying.
We do have Scott there in the corner.
Yeah, we got Scott.
I can do an interpretive version of the slide.
You don't want to see us do interpretive dance, though.
Okay, so there we are. All right, we're back to normal. What's that? You want to go back? Yeah. Okay. Yeah, so this is where I started, and I talked about the prices and how they've fallen in recent years, but you can see, at least in this average price paid to farmers, broad index of prices that the National Agricultural Statistics Service collects, those have been up over the past year, as have livestock prices. And while they, again, are well below the peaks hit in 2012-13, we have seen, at least relative to long run averages over the last 10 years, for example, where even adjusting for inflation, that the prices are similar to those levels. Now, let me move forward. USDA calculates two broad measures of farm income. Net cash income is a measure of a farmer's cash flow. Essentially, you take roughly production or cash receipts from what's sold that year, farm program payments, and minus cash expenses. The ERS's, that is the Economic Research Service at USDA, their latest estimate of net cash income for 2017 is $100.4 billion. there, yeah. Even adjusting for inflation, net cash income is down about 30% from 2012 levels, but it remains above the 10-year average, and it's up almost $10 billion from 2016 levels. Net farm income is a measure of the net value added by farm operators to the national economy, and that's projected at $63 billion. Net farm income includes a lot of other things. It's more of a national income account measure. It includes things like changes in inventory, home consumption, and I think significantly, at least in this case and what we've seen over the last few years, are things like depreciation and capital consumption. And one of the reasons net cash or farm income has decreased a lot over the last 2 or 3 years is the fact that it includes very large capital consumption numbers. Depreciation is up significantly. Why? Because farmers bought a lot of machinery during the boom years of 2011 to 2013. ERS also measures farm business income for farms that report more than $350,000 in sales. These farms account for the bulk of U.S. farm production, and they're in looking at their projected 2017 farm business income, many of these farm operations, at least by type, should see sharp improvements. Compared to 2016 levels, net cash income is projected up 35% for hog producers, 40% for dairy producers, and up almost 15% for beef producers. On the crop side, net cash income for cotton producers is projected up 29%, and wheat producers about 12%. Now, looking at it a little more broadly, looking at the last 7 years, and again, adjusting for inflation, net cash income is projected up almost 12% for soybeans, 21% for dairy, and over 60% for cotton. Most of the other commodities you can see are at or slightly below the 7-year average, with the exception of wheat, which is down almost 47%. The decline of wheat relative to other crops in part explains the decrease in wheat plantings that we've seen. Wheat area is down about 10 million acres over the past few years. And again, I think this is fully reflective of the fact that wheat, is certainly relative to corn and soybeans in particular, has been less competitive, and farmers have moved out of the planting wheat. The financial health of the sector remains strong. Despite farm debt projected up 3% in 2017, solvency measures such as the debt-to-asset ratio remain low. Farm liquidity has decreased, but measures such as the debt service ratio, that's the amount of production available to meet debt, remain well below levels of the 1980s. Based on recent reports from the Federal Reserve districts, the percent of ag operating loans that are non-performing, that is, that are more than 90% delinquent, that's about 1.4%, and are among the best performing lines of debt. Compare this with comparable data on credit card debt, where 4% of the loans are more than 90% delinquent, or student loans, where the percent of delinquent loans past 90 days is almost 10%. Lastly, household income for farm operators. Farm operator households remain high relative to non-farm households. ERS forecasts median farm household income at $77,000 for 2017. Based on what we saw for in previous years, that it implies that the farm household income is about 35% higher than the median household income reported for all households. Oops, sorry. In general, median farm household income levels have exceeded non-farm levels since the 1990s, far different from the situation facing agricultural sector in the 1930s, when farm household income was less than half that of the non-farm sector. The relative affluence of the farm sector is not just due to hobby farms, which is, I think, the perception of many. Of the 2 million some odd farms, about 45% of the farm household operators consider farming or ranching their principal occupation. Those farms account for over 90% of farm production. Their median household income was estimated to be about $63,000 in 2015, about 12% higher than median household incomes of non-farm families. Over the past 50 years, non-farm income has become an increasingly important source of income for farm families. Income from farming by its very nature is variable. Supplementing farms with income from non-farm sources helps stabilize year-to-year fluctuations in farm household income. And let me turn back to this chart. You can see the red line there is the year-to-year change in farm income, the farm portion of household income. And then if you look at overall income by the farm households and look at year-to-year variations, you can see that's that dotted line there. And all it's to say is that off-farm income has been very instrumental, at least, and has become an increasingly bigger portion of total household income for farm families. You can see how that this, in fact, helps stabilize and buffer what is a far more variable farm income. So let me conclude by just saying, while not being overly Pollyannish, I think it's important to keep the current state of the agricultural economy in perspective. Yes, crop and livestock prices have fallen from record highs, but remain above 10-year averages. Higher yields have partially offset those declines, and which has helped buffer farm receipts. Net cash income, I think the best measure of a farmer's cash flow, is projected up $10 billion over 2016 levels and remains above long-term averages, even adjusting for inflation. The financial health of the sector remains strong, debt remains low relative to assets, and the farm loan delinquency rates remain low. Farm household income remains high, in part because the non-farm economy continues to recover. Income from farming and ranching can be volatile, and off-farm income has helped farm households buffer that volatility in farm income due to weather and market prices. Farm programs were originally justified on the basis that farm household income was a fraction of that of non-farm households. Today, farm households tend to have higher incomes than non-farm families, and that discrepancy has grown since the late 1990s. And with that, let me pass it to Barry.
There we go. Okay, thanks Joe, and thanks AEI and everyone for coming. Vince asked me to talk mainly about the Title I commodity programs, and I'm going to do that. I think to put it all in perspective, and this is a bit repetitive of what Joe said, but if you look on the left, this is the same diagram, but a much longer period of time. And I just want to start and preface the discussion of the specific policies with again this basic point that yes, farm income, net farm income is down over the last couple of years, but it's really coming back to something that's more normal, and you can see it over the very long run there. See the farm crisis of the 1980s, and then steady but volatile incomes to some extent, I guess. But you can see the rise, and then we're back again to similar levels from what we've seen. And I won't say a lot more about farm income versus off-farm income, except that I think you have to look at, if you're concerned about the economic well-being of farmers, you need to look at the farm household as a whole. And you know that this is households that are primarily farm operators, and you see the incomes are higher. Even among those households, they still have a significant amount of income from off-farm sources. And what we didn't mention is if you look at wealth, this picture becomes much more skewed in favor of farms. And that's part of what lies behind the very good financial indicators. Farm households tend to be, what, Vince, 4 or 5 times, 10 times, I don't know what the numbers are.
Well,
much more
10%
wealthy.
of farms that receive 70% of the payments have a net worth of $6.8 million on average.
So it is I think USDA considers 95% of U.S. farms to be high income, high wealth. Okay, and you can debate those definitions however you want. But Title I programs, we're really talking about the ARC program, which essentially exists only at the county level. That's where all this enrollment was. Price loss coverage, PLC, which is very much akin to the old countercyclical payments program. And then something that's grown, and Vince will be telling you a lot about this, but you all know has grown a lot over time, is crop insurance. And it's a very significant part. The biggest scored budget item in terms of the farm programs, though ARC and PLC have turned out to be a bit more expensive because prices have fallen more than anticipated. Again, the so-called safety net, and that term doesn't bother me as much as it does some economists, but it is in the jargon of what we're looking at with these things. We have seen this shift away from Title I spending, marketing loans, countercyclical payments, market loss assistance, whatever you want to call those. We've seen a shift away from that toward federal crop insurance and a much less of a role for ad hoc disaster relief. As a share of production, I think it's useful to look at how much the taxpayer, the government expenditures and support really mean in terms of the value of the commodity. And there's a lot of heterogeneity here. I'm going to show you some numbers that Dan said this morning. He doesn't like looking at things on a per acre basis or per farm basis, and I agree with that. But just remember, in all these statistics, there is a lot of heterogeneity that's beneath the numbers. But peanuts really stand out for getting a very high level of support, and you're going to see the usual players here: rice and cotton, corn about 11%, and that's right on average with all commodities. There we go. Outlays per acre. Sorry, Dan. Peanuts again rises up to the top there, and so much of that comes from PLC. Almost all of it. You see a role for crop insurance there. Rice and cotton again. Same story. Corn about 65, give or take, dollars an acre. The money being spent there is in the form of ARC at the county level. ARC enrollment, let me just stop and say a little bit about base. I think I probably didn't explain it as well earlier this morning. Most of you, I'm sure, are familiar with base, but I think one of the critical things to be watching for, as the Farm Bill is discussed, is this issue of coupled support versus decoupled support. ARC and PLC are paid on base, which is based upon some historical level of production. There have been base reallocation and yield updating that really ties that much closer to current production. I think there's an interesting question there, how decoupled that support is. But in the last Farm Bill, there was a lot of debate about whether we want to tie support to current production, like marketing loans would be, or should it be paid on a base. And of course, crop insurance is what Vince is going to talk about, is intimately tied to current production. It's an important distinction, and I'll show you why here in a minute with what's happening with some of the base acreage numbers. Got the wrong thing circled here, in fact, but almost all corn and soybean farms and base acreage went to ARC at the county level. No one, for the most part, enrolled in the individual coverage level. PLC, that was supposed to be corn and rice and peanuts circled there, but peanuts, rice, corn, canola you see, but rice and cotton, I believe. No, cotton's not relevant here, but much more in the column of PLC. So it's no mystery why when you look at the support figures that we were just looking at. An interesting thing, if you sort of follow CBO projections of where we're going on things, they are expecting a lot of movement out of the agricultural risk coverage, the ARC, into PLC. That's because prices are coming down and the benefits are going to shift toward PLC in favor of it. Just to see where the dollars are going, and you pick any particular year and you see different things. 2015 had a very good crop, and prices were depressed a bit, and you see, not surprising, the Corn Belt is where a lot of these payments went. And if you look at this on a payment rate level, you can see where the payments were really focused. Certain areas of the Farm Belt, or Corn Belt, Ohio, and so forth. The PLC target price, again, peanuts. Peanuts are are at the top of every list here. And canola shows you the high enrollment in canola, which is a minor crop, but rice is there as well. You can see where the target price is relative to the market price there at the vertical line, the 100%. So corn is just barely across, wheat more substantially, and so forth. Okay, the base versus planted acres. I think this is going to be an issue that is going to get some attention in the discussions. We see actually base having more acreage than what's currently being planted right now for some crops, not others, not the case for soybeans, but for corn and wheat and so forth. Cotton was turned into a generic base, and that's what we're looking at there for cotton. But there's going to be some emphasis once again, I think, on directing some of the support toward current production planted acreage. There's WTO implications from that, things to consider with that. And I'll turn it over to Vince now.
So my brief, I almost said my beef, but it should be my brief, is to discuss crop insurance. And I want to start with some basic facts because while I know there are people in the room who know a lot about this program, many people in the room are probably not as experienced or haven't been as confronted as often with some of the basic issues with crop insurance. There is a very substantial body of academic research spanning 40 years that clearly indicates farmers do not buy multiple peril crop insurance if they have to pay the commercial cost of the insurance because they have cheaper and more efficient ways of managing risk. And parenthetically, though some lobbyists for crop insurance would argue to the contrary, there is zero evidence that there's a market failure here. Now, multiple peril crop insurance, by the way, is all risk crop insurance based on a farm's individual yields. So if you have low yields at the farm level relative to your long-run average, you get a payment. There's no evidence that the commercial sector is failing to provide this product because of a variety of non-market related or barriers to entry issues. Just zero. Anybody who claims to the contrary is mistaken, and I'm being polite. Subsidized crop insurance encourages farmers, in fact, and again, there's a substantial body of evidence in the academic literature for this, to adopt high-risk production practices that in fact waste resources. And they do so because taxpayers cover their losses when their high-risk production practices result in adverse outcomes, planting on fragile lands and getting low yields, for example. And fundamentally, what's happening with federally subsidized crop insurance, where we pay 63% or thereabouts of the farmer's actuarially fair premium, and we pay all of the administrative costs to the insurance companies. This program has shades of the 1980s savings and loan crisis, in that the same sorts of incentives existed then for savings and loans companies. And those of you who are old enough in this room, and you're an older crowd than I see usually, so more my type of people, will remember this came about because of bad government policy. We have the same problem here. The only saving grace is that farming is 1% of GDP, not 10 or 12% of GDP. And so the costs to us are relatively small. Some more basic information. CBO forecasts, and these are rounded, but the CBO forecast is that over the next 10 years, each year farmers will receive on average about $16 billion a year in crop insurance subsidies. About 81% of that money goes to the largest 20% of farm businesses, and some recent research by some of my colleagues shows that 70% or close to 70% goes to the largest 10% of farm businesses. This is not a poverty reduction finance alleviation program. It's actually an income transfer program to relatively and very wealthy individuals. On average, you will hear people who like crop insurance say, You know, this is a good policy because farmers have to invest their own money in the program. And in some obscure sense, that is correct, in that they do pay part of their premium. But they get back on average more than $2 for every dollar they put in, which is an annual average rate of return of about 100%, or 105% to be more accurate. And if only I could guarantee those returns from my retirement portfolio, I'd be really happy. The USDA, just parenthetically, spends an additional $80 to $120 billion a year on managing the program that aren't in the direct numbers. So by any measure, if we think of this as an income transfer program, it's a relatively expensive way of transferring income. You could just write the check and off the bat save $2.5 billion, $2.6 billion. Just to some quick indicators of what's been happening. Back in 1981, very little crop insurance was used by less than 10% of all farms. We subsidized it at the rate of 30% on what's called the actuarially fair premium. The government's always paid all of the administrative costs of this program. And participation went up to about 25% on average. We bumped the subsidies because that wasn't good enough to roughly 42% in 1994 through the Crop Insurance Reform Act. Reform for farmers, not necessarily for the rest of us. And participation grew, some subtleties in this area, but it grew fairly substantially. And then that wasn't good enough, so in 2000, the Agricultural Risk Protection Act was passed, known as ARPA. Acronyms are terrible in this world. And now we have about 90%, between 85 and 90% of the acres, of all acres planted, insured under this program. The expansion has been driven by the subsidies, not by lots of hard work on the part of crop insurance agents. I'm sure, by the way, crop insurance agents do work hard. They compete with one another for lucrative bits of business, but it's the subsidies that have driven participation. And crop insurance expenditures have grown substantially. Barry Goodwin and I wrote, I guess, the book on the U.S. crop insurance program in 1995, when spending was relatively little on it. It is, 30 times more now, 40 times more?
You guys must not have been very persuasive.
We were not persuasive because we said this is not a good idea as a program. We're failures as usual. We economists are not successful in many directions. Loss ratios for the program. RMA will report that the program is actually, especially since 2000, working well in that loss ratios are generally well below run and average about 0.8. That is, for every dollar paid into the insurance pools, they're paying out about 80 to 85 cents. And that's right. The problem is that farmers are only putting in 40 cents of every dollar into the insurance pool. So if we compare losses to what farmers actually pay for the insurance, they average, as I said earlier, over 2. That is, $1 generates more than $2 on average in subsidies for farmers. And that's the orange line. I want to spend the last minute or two doing two things. One, talking about the harvest price option revenue insurance product, which is now, in a way, somewhat deceitfully, but in another way not, described by RMA as revenue insurance. It used to be called revenue insurance with the harvest price option. But because that program is so lucrative, for those farms that can use that option, and those are corn, wheat, soybean farmers, and other farmers where there are well-functioning futures market, 70% of the book of business, roughly, is now in this particular option. It's widely viewed as Cadillac insurance. In some situations, it actually enables farmers to receive more revenue than they expected when they planted a crop by valuing crop losses at harvest time prices when those prices are unexpectedly high. Well, when will that be? When there's a shortfall in yields. So in 2012, for example, on average, corn growers got about 11% more in revenues from indemnities in the marketplace than they expected when they planted the crop. So in other words, this product doesn't make you merely completely good, effectively no deductible, it makes you better than good. If only I could have that on my house, but then I might burn it down, so that would not be so good. And this picture just shows how revenue coverage has really expanded since it was introduced in 1995, and particularly after 2000, which was when the harvest price option became eligible for subsidies. If you buy that option, on average, you're going to get bigger subsidies than if you buy any other type of yield insurance or any other type of subsidized insurance. So what should we do to reform the federal crop insurance program? Well, suppose that I was talking now about kumquats raised in New Zealand. I'm not quite sure if they raise those, but maybe they do. And I told you the program had complex and in many dimensions adverse environmental and trade relations impacts. I told you that it encouraged the owners of businesses to adopt wasteful production and management practices, which it does, and it annually wastes over $8 billion in scarce federal funds that do have competing uses. And it overwhelmingly gives subsidies to large firms that are owned by people who have no financial need for help. Just parenthetically, the number of farms that fall below the federal poverty line as a proportion is 2% of those farm households, 14.4% in the general population. And those small farms, by the way, get virtually zero in the way of help out of these programs. I think you'd all say, let's get rid of that program, it's poor public policy, unless you happen to be the recipient of the subsidy. But in the real world, it's going to be very difficult for that to occur. There are strong and powerful interest groups and with representatives in Congress who are not going to let that happen. At a minimum, let's stop subsidizing Cadillac insurance, the harvest price option. This is a proposal that's been made by more than one congressional member who's concerned about waste in the farm subsidy program. Subsidies should be rolled back to 2000 levels, perhaps. That's an option that could exist. Taxpayers would only pay 40% of the cost of the farmers' premiums rather than 60 to 64%. That would actually save about $3 billion a year, it looks like. You can buy, and almost everybody buys, as part of their federal crop insurance program, a prevented planted coverage. That is, if you can't plant your crop for some reason, you're covered. That program is subject to fraud, and it's extremely difficult for the insurance companies to manage in an effective way, or loss adjusters to assess whether or not the losses are actually sufficiently significant. The problems are rampant in the program, as work by Barry Goodwin has shown. Premium subsidies could be capped on a per farm basis. Right now, there are 23 farms or so that receive well over $1 million each in this program in subsidies. If you capped these subsidies at a mere $40,000 per farm, which is close to, by the way, to the median household income in and of itself, you'd affect 3 to 4% of the farms. You'd save about $1 billion. And permitting farmers to sign up for their insurance online and companies to compete for business among farmers on the basis of price would also reduce some administrative costs and might reduce some taxpayer costs. We're not quite sure by how much. So with that, I'm going to turn it over to Dr. Sumner to provide a summary.
So you've heard, 642 numbers from my, I hope I won't, I don't plan to give you a single number in this presentation because I want to take a step back. I may give you a date or two. Today we're launching a program called Agricultural Policy in Disarray. Some of you may remember there was some work, the agricultural policy work at the American Enterprise Institute goes back to Gail Johnson. Back in the 1950s and 1960s, Gail had a famous book called World Agriculture in Disarray in 1973, and we're referring back to that, hoping that the U.S. government doesn't contribute to disarray in agricultural markets. And that's really the theme, I think, you're hearing here. I want to go back, in a sense, to first principles then. We've heard a lot about the evolution of agricultural policy. I think Joe mentioned correctly these programs go back to the 1930s, and that's certainly true. And for a very long time, people like the American Enterprise Institute have been pointing out problems with these programs. I would say, in fact, though the progress is slow, AEI is winning in this discussion. That is to say, the policies that we have today cause less disarray than the ones that Gail Johnson was talking about in the 1950s and 60s, when we were requiring year to year farmers to leave 25 and 30% of their land idle. Incredibly wasteful way to do business. When we were paying farmers specifically to particular crops that were then put into government storage to let rot or shipped off to somewhere to distort somebody else's market. We're doing less of that all the time, and that, I think that's progress. We were giving a little briefing up on the House and among staffers. Many of you know the median age of a House of Representatives staffer is 26, something like that. They need that history lesson, and they also need to know that just because things don't have to be the same way they were last time. And I think that's what we're saying here. They don't have to be the way they were last time. And in fact, as years gone by, I think the programs have moved along. What we're really talking about here is we spend lots of money. You heard a lot about it. We have lots of regulations. You heard less about that. We have very specific regulations setting relative prices of this product versus that product. The government will pay you this much for cheese, but for dry milk powder it's that, for whole milk powder it's this, for whey it's something else, for setting market prices or minimum market prices. Why do we do all this? Nobody can remember anymore. See, the programs in one form or another, pretty much like they are now, go back to if you talk to a farmer of my age, they'd say, oh, well, I don't remember, that was my grandfather's day. But for the average farmer, it was their great-grandfather's day. Nobody still alive remembers why they're doing this, but we've always done it, so I guess we need to. And so years ago, I wrote an AEI piece where I said, what are the top dozen reasons people list for having these programs? And I checked them off one by one and said, now that doesn't really hold water. That doesn't make sense. Joe mentioned, for example, that the average income of farmers during the Depression was below the median income. Everybody was poor in America, not quite, but lots of people were poor, and farmers were even poorer. And so maybe that was a reason. I actually think it probably wasn't a very effective program even then, but that was a rationale. That ended in the 1980s. That was gone a long time ago. You go down to the next one, you say, well, gee, does it help farmers deal with monopolies? Maybe there's monopolies of buyers or sellers or something. Well, it turns out there may be, but these programs have nothing to do with that. They don't help farmers in that. What about natural variability in market prices? For a long time, we'd said, oh, gee, we have to have big government stocks because otherwise commodity price movements would be unusually high. These programs aren't doing that either. So we go one by one. I finally got to my reason number 13, which I think is the only one that I take quite seriously, and that is that we have these programs because we've always had them. And don't laugh, because I think it's serious. When I talk to farmers, rice farmers in California or cotton farmers in Texas, they really do say, I can't imagine what it would be like without them. It's really hard to think about that. So, this is what I'm doing for a living. I'm putting my kids through college with this. Don't change anything. I can complain about stuff, but don't change it because things are okay. And so I take that reason seriously, but I don't think it's enough. And that's where I agree with you. I don't think that's enough of a reason to leave things as they are, or even to just marginal around the edges. The other point I want to make is that we don't subsidize all of agriculture equally. Barry talked a lot about peanuts, but we're talking mostly field crops here. If you asked, what are the most successful industries in U.S. agriculture? Is it the subsidized crops? Is there some evidence after 80 years we've we've got these industries on their feet, they can take care of themselves. Well, evidently not, because they're the same ones that want to be subsidized again. If you went to where, so one thing you might say is, well, we do these because this will encourage farmers to be innovative and dynamic and vigorous. It's good for the rural economy because we've created some innovative industry here. The answer is the evidence doesn't support that. If you look for what is the avocado industry a bunch of dullards because they're not subsidized as much, I don't think you'd say that's true. What about the carrot industry? What about the whole fresh vegetable industry, for that matter? And on down the list, alfalfa industry, they don't have all these programs. You didn't see there's 70 or 80 million acres of hay in the country. You didn't see them on that list. Those are dynamic, vigorous, serious farmers doing innovative things. They just invented subsurface drip irrigation for alfalfa. Did they need farm programs to come up with that? No. And in fact, if you talk to the individual growers, not the ones that come to Washington, they're here for a particular reason, but go out there and talk to growers, and you'll find that what they'll tell you, whether it's the dairy industry or the hay industry or the corn industry, they'll say, if anything, the programs get in the way of innovation. You know, they provide price supports for this commodity or this specific thing or that specific thing, and they actually reduce the vigor and innovation of American agriculture. If you look around the world, you say, gee, those farmers in New Zealand, they're a bunch of dullards. Obviously, they can't compete in the world because they don't have subsidies, or Australia or other places. Frankly, even the European Union is moving out of subsidies in the way that we have them, tied to particular commodities and the like. So the answer is, has it made this a vigorous, healthy industry? Has it solved all the problems for them? I don't think so. In fact, if anything, I think for the long-run health of the economy in America, it's probably caused more problems than it's. So we come back and say, what is there a role for government? And I think the people up here, all of us, we might differ a little bit, but we'd all say there is an important role for government and several roles for government in American agriculture. I just landed this morning on a red eye from San Francisco because I was working on wine grape fire issues. Is there a role for government in helping deal with those fires? You betcha. There's issues related to smoke taint in the wine. Are there people working on that at the universities, researchers, other people trying to come up with stuff? Yes. Is there government funding for that? Yes, there is. Those are the kinds of things where there's a role for government. Disasters, same in the Southeast. Was there a role for government there? I think most people on this panel would say yes. We could disagree. So we're not saying, you know, run naked in the bushes here. What we're saying is, let's be careful to use our dollars and our regulations in ways that make sense. And particularly tying up agriculture where you end up saying, gee, we're going to do farming by grant. We're academics, we apply for grants all the time. Do we really want farmers spending their time applying for this or that grant to be able to make a living? And that, I think, is a theme that we want to keep. A couple of farm bills ago, 3 or 4, the American Enterprise Institute put out a book on trade policy called Letting Markets Work. And I think the theme here is let markets do what they can do, and we don't really need to tie that up with regulations, taxes, subsidies, and all that stuff, because in fact that creates the disarray that Gail Johnson talked about a generation or two ago. So let me stop there.
Great. Okay, thank you. We've got about 10 or 15 minutes for your questions. So maybe I'll just start to kind of get the conversation going. You've heard a lot today about particular policy reforms, especially to the crop insurance program. 2 of those were proposed by the Trump administration in their budget, eliminating what Vince described as the Cadillac insurance subsidies, the harvest price option, and the other was capping premium subsidies. And I think one question for many folks at home or here in the room is, what effect would that have on the farmers who are currently benefiting from those subsidies? What impact would it have on farm household income? Would farmers no longer choose to participate in crop insurance programs if we capped subsidies or eliminated this especially generous harvest price option?
I'm sitting next to the 2 of the leading researchers on crop insurance. I'd like to think I am too, but I do respect my colleagues, so they may have something to say about this. The odds are that, well, firstly, a cap of $40,000 affects 3.9% of all farms, and those farms are not going to change their production patterns or anything like that simply because of only being able to access $40,000 a year. The other 96% of farms by that would not be affected. If the Cadillac insurance product went away, firstly, if farms want to hedge against price for the crops for which this is available, they can do so in private markets. And the Crop Insurance Act actually specifically prohibits RMA from offering competing products. So the HPO is actually in contravention of the underlying legislation. An interesting thing. The caps would have very little effect per se. The harvest price option, you still have yield insurance available to you. You would still have a standard revenue insurance product available to you. Those products are not as lucrative. Your subsidies will fall a little bit. Well, actually quite a lot, because getting rid of the HPO subsidies would save about $2 billion. That means farmers are only getting $4 billion. That means they're only getting 2/3 of the amount of money of subsidies. Some time ago, one very prominent economist working for a very prominent lobbying group admitted in public that if you took away all farm subsidies, agricultural production would change relatively little at all. The sort of story you might have heard, gee, we'll become food insecure, the validity of that argument is about as great as the validity of claiming Stephen Colbert is an expert on absolutely everything in the world. In other words, it's complete nonsense.
Joe or Barry, do you want
Yeah,
to
let me just, one, I do want to modify a little thing. Congress did go in and actually
Did they
change the law and allow subsidies on HPO, so it's not quite in contravention of the underlying Crop Insurance Act. But I think actually that is an important point that you raised, because when revenue insurance was first offered, there was an option for this so-called harvest price option. It wasn't subsidized, or you received the same subsidy as the underlying yield policy, yet plenty of farmers bought it, and they found it very popular. And I also would agree with the recommendation to eliminate the subsidy on the price portion of the harvest price option. I think that, and I would agree, again, I do think that does compete with what is available in private markets, but I have no problem with private sector offering that coverage, and I think farmers would, a number of farmers would continue to purchase it at least in answer to your question, Scott, about how that would affect things.
Thank you.
I want to toss in 2 seconds worth, Scott, on the idea of payment limits on crop insurance. And the reason I've never been a fan of payment limits is basically because I think it misleads people about the purposes of these programs. Nobody for 30 years should have any illusions that these are programs for poor people. They're just not. They're for businesses. They're for substantial sized businesses. And let's evaluate them in that way. I think they fail, frankly, as subsidies for substantial sized businesses. But to think that you limit it to little farms or something and that somehow makes it okay is just wrong. I think that sending that signal is just wrong, whether it's caps on crop insurance or anything else. The program, I think, is a mistake much more fundamentally than rich people get the money. Because anytime you're going to subsidize an industry, if you're subsidizing a substantial part of the production, if that's why you have the program, the big parts of the industry are going to be the ones getting a subsidy. Of course, whether it's automobile subsidies, you name it, no matter what it is. You can't subsidize the electricity industry and say the top 40 electricity companies don't get the subsidy. That may be something. But you're also not subsidizing poor people. And let's not confuse the farm as a business with a household as a family, because those are different things. And so that's the only place I would disagree with this. I would pull the plug much more thoroughly than only going this half measure.
Well, I'm with you, by the way.
Yeah, I figure you would be.
Yeah, I just add one point to what Joe said. Financial markets have been very innovative and sophisticated in developing risk management tools, but there's no way that you can compete against a 65% plus operating, probably 50% there, 25% subsidy. It just can't happen. And a lot of people want to say the government has to be involved because private markets would not take on this risk. I've never, back many years ago, we looked at this argument. I've never found a persuasive argument. The reinsurance capacity in the world is in the trillions of dollars. The capacity there is very good. Private risk management instruments are being developed by the same companies that service these and sold on top of it. I think the harvest price option, like Joe said, the private markets could pick that up right away if farmers didn't want to go the options and commodity exchange route.
Yeah.
But it's not a case of the government being there because private markets haven't been able to. It's just the opposite. Private markets can't compete. They've been crowded out of this space. And I think there's a great appetite in the marketplace to have, to invent and innovate in this space. But it's not going to happen when you can't compete against a subsidy like that.
So we'd love to hear your questions. We have one over here.
Hi, Tara Smith, actual farm kid.
Hey.
Grew up on a corn and soybean farm in Illinois. Work for the Crop Insurance Coalition now, and actually work for Senator Roberts on the Ag Committee during the last Farm Bill. This has been an enlightening discussion. I take issue with several of the things that have been mentioned, but don't want to bore this audience or hijack the questions. I do have one comment and one question, if that's okay. Mr. Sumner, you mentioned the wine grapes. Just so you know, rest assured, a lot of those wine grapes are actually insured by crop insurance. And so the crop insurance companies will be stepping up to the plate, paying claims on those wine grapes. Wine grapes are actually one of the top 10 commodities insured by crop insurance. It's not just a corn, wheat, and bean program. So rest assured, your wine grape growers will be able to continue production next year because they had crop insurance, and crop insurance will help them do so. My question, talking about private sector products and how we don't need public sector assistance to have private products available. Certainly we have had some private products offered in the past. We've gone great periods of time in this country where there has not been the crop insurance program that exists today, where we've had no crop insurance or very minor crop insurance program with almost no subsidies. Can you talk a little bit about why you don't think a rigorous private sector industry came up during those times? Why didn't it exist then? But for some reason, if we got rid of subsidies today, it would suddenly occur today.
Well, let's go back and ask, how many of you remember, because I remember this because it happened in about 1975, the pet rock industry, right? Why did we not have any of those? The answer is it cost more to package the pet rocks than eventually the young men who gave them to their girlfriends thought they were worth. No, that's a frivolous example, except that it's exactly the same reason. It is very clear, what I said earlier, certainly for most of the history of insurance, the case is if a commercial crop insurance product is offered, the overhead that the crop insurance companies would need in order to operate, which would be at least 40% of the expected indemnity, makes it a highly expensive way for farmers to manage risk. They have a plenitude of alternative ways of measuring risk. We know from our own research that the evidence from a huge body of studies, not just in the United States, but in Rwanda, in Morocco, in Australia, the evidence is that almost no farmer will buy crop insurance of the sort that we offer here if the overhead charge exceeds about 10% of the expected indemnity. And it's stunning how these studies carried out by many disparate researchers come down to the same point. In other words, the cost of offering the insurance by the private sector, at least historically, and I would marginally disagree with some assessments, the cost of operating the insurance exceeds the cost of managing the same risks in other ways, in many other ways. And I'm sorry, but whatever you want to believe differently, that's the empirical evidence.
Yeah, Vince and I disagree a bit on this,
not much.
the potential for private markets, but I would say, just to put my interpretation on what Vince said, just because it doesn't exist doesn't mean the government has to make it so through subsidies. And
Yeah,
That's not what you said.
if I may say something, I mean, one is I think you just said this, in one sense, you said the same thing that Tara said, that is, without subsidies, these markets wouldn't exist. And I think that's a fair point. And I think that the point I think that Barry and I were saying is on the harvest price option portion, if you were to take the subsidy away from the price portion of that, would there still be a market for those? I suspect there would be. Now, participation may not be as high on that because farmers would have to pay more out of cost for that. But I think there would be a market on that. And I'm talking about premium subsidy. I'm not even talking about reinsurance. Presuming reinsurance were still there, I presume that companies would still offer that. And in fact, we knew that they were offering it without in terms of add-ons and everything. The companies actually have been very innovative in terms of developing specific add-ons that they compete in the market with that aren't subsidized. And I think but I think there's no question, and I think we're all in agreement that if there weren't subsidies, and if you were trying to offer multiple peril without subsidies, I don't think you'd have very many people buying it.
Scott, one quick point for those of us that aren't crop insurance specialists. The argument here is about the nature of this specific multi-peril crop insurance, blah, blah, blah. And I think there is a consensus that would not exist without large government subsidies. It was something that was created by government and probably wouldn't be there without. And the point that these fellows were making was that there are other instruments for risk management, many of them related to financial risk. Things look kind of like insurance, but certainly not like this federal crop insurance. I think you're right. It wouldn't be there. It was invented by the government. It wouldn't be there. Did that mean that farmers couldn't manage risk? No. Does that mean the farmers that tend not to participate in crop insurance can't manage risk? That answer is also no. There are other instruments they tool. They may be financial instruments. They may be crop diversification. They may be planting on land that's a little less fragile, little less changing what you grow on which kinds of land. There are ways that farms and other businesses deal with risk, and the argument from most people on the panel is that those things would be more used if they weren't crowded out by crop insurance. That's the point. With respect to wine grapes, let me be very specific. The only part that's not harvested yet is about 30 to 40% of the Cabernet Sauvignon in Napa Valley, and that stuff is selling for $6,000 to $10,000 a ton. That's wine that's $60 to $120 a bottle, and that's not a crop insurance item. What you're talking about for wine grapes is the stuff that sells for $400 a ton out in the middle of the Central Valley where I'm from. And that stuff, they do buy crop insurance. It doesn't pay off very much. It's usually catastrophic. It's free for the farmer. The insurance company makes money, but the farmers is sort of an irrelevant thing.
Got time for maybe a couple more questions right here, sir.
My question is much more. My name is Dan Silverstein. My question is much more practical and cuts to the chase. I was thinking that Speaker Sam Rayburn was famous for saying, if you want to get along, you got to go along. We don't live in that era anymore. So where is the coalition of representatives whose constituency isn't represented by agricultural interests or farm communities, recognizing what you've pointed out here today about Cadillac insurance policies and draining the swamp of this government subsidy? In other words, what's the practical application? Is this going to change, or is this embedded forever?
You did cut to the chase. I was wondering what chase you were going to cut to. The bottom line is that in some sense, economists operate like Chinese water torturers on stone, one drip at a time, and eventually the hope is, and Dan raised this point earlier, eventually, gradually, when things get so transparently wasteful, if you like, and expensive.
That was fairly transparently wasteful what you showed on the screen.
Oh, yeah.
How much more transparently wasteful does it have to get?
Well, it has also to get relatively large. Gary Becker argued that the Nobel Prize winner in economics said things have to be bad and be obviously bad and even be bad for budget makers. But the answer is within the congressional membership, as in particular in the very short term, concerns are increasingly being raised about the size of the budget deficit in the context of a tax bill that almost certainly will substantially increase the deficit, and B, the somewhat deeply concerning possibility we might end up in a major war. In that sort of setting, where's the money going to come from to fund other needs? And so there are congressional delegations, particularly in the House, but also to some degree in the Senate, who are concerned about this. And they're concerned about it because in the end, it's hard to argue that shifting relatively large compared to their revenues, amounts of money, to individuals in ways that are already quite well off or very well off, in contradistinction to what the farm lobby tends to argue, in ways that waste economic resources, that's just really poor policy. And if the economists who write on farm policy, and we're talking about, one of my colleagues at Montana State says, 95% of the economists who look at farm policy say very much the same sorts of things that Dr. Sumner said, Dr. Glauber, Dr. Goodin, and myself say, Dr. Babcock, for example. None of us are saying that most of these policies, especially the income transfer policies and policies like the sugar program, are a good idea. The other 4%, he argues, are being paid by farm interest groups and the crop insurance companies, but that's a different story. The general consensus is, look, these are wasteful programs. They no longer serve the purposes for which they were originally intended in 1933, and when 47% was the ratio of farm household income to the average income in the country. It's flipped, if you like. It's hard to see, I don't care what side of the house you come from, unless you have a vested interest as a recipient of these payments. It's really hard to see why these policies are any good. Now, that's not unique to farm subsidies. We just think about healthcare devices, for example, where you see the similar problems, but yes.
Yeah, I want to just make one more point to this. I have heard, and there's some disagreement amongst us, I guess, in terms of what the world would look like in lieu of the federal crop insurance program. I don't think we know exactly, but we like to say, well, we know what it would be like without the subsidies we have now because we were there in the 1980s. And the fact is, agriculture is entirely different than it was at that point in time, and so are financial markets, and so are financial instruments, so is precision agriculture, so are all these things that could be made into risk management instruments through private market insurance. I would never say that a 90% participation rate would be what you would see with the unsubsidized insurance, but there's the lessons that we get from agricultural insurance are very similar to what we get from other lines of insurance. The distortions are very much the same. You can end up subsidies can end up suppressing innovation and things like that.
Well, and I would agree with that.
Maybe one more question, and just to quickly an addendum. There are a number of groups here, but also probably watching, like Taxpayers for Common Sense, R Street, Americans for Prosperity, who are trying to bring more attention to some of the maybe too generous subsidies included in these various titles of the Farm Bill. So you might want to reach out to some of them here. Maybe one more question right here. Ma'am, go ahead.
Hi, thank you so much. I got a great perspective. I was going to ask my question to Dr. Sumner, but I guess I'll open it to all of you.
He had to catch a plane.
Yeah. He mentioned the fact that the aid and subsidies in Europe are getting decoupled, and also I think Dr. Goodwin also mentioned something like that with the WTO. But I'm just wondering, are there proof that decoupling help actually reduce the subsidies that farmers get?
Yeah, let me just say, I think just in terms of the amount of money that is being provided to the farm sector in Europe, that is still quite large. And what the EU has done is they have shifted away from coupled support. That is where farmers get now more payments across the board, more just direct income support, but not tied to specific crops or that. Now, I might add, Europe too has gone through debates on whether to recouple some of those supports. You see that debate going on. And there's a whole literature about, which Barry may want to comment on, and because he's done some research in this area, on whether or not decoupled supports actually has some production impact as well. And there's still a lot of money going to the farm sector in that sense.
Yeah, one thing that took place, there's not a big production effect. We wouldn't expect it to be, but I think politically, with the high incomes we've talked about, making these large checks, $5 billion a year in total, a lot of times to agricultural assets that weren't engaged in production, it just became very politically difficult here. I don't know if that's going on in the European Union or what. But
So I have to talk about Brexit. Sorry, I'm English in the first place, and I find it appalling that we're going to, that my other country is going to leave the European Union, or maybe not. There's a glimmer of hope here. The Brexit debate in relation to agriculture is really kind of interesting. The single farm payment, which is the largest source of funding that goes directly to farmers out of the European Union's program in the United Kingdom, it is quite likely that that single farm payment will disappear. Why? If you look at the people who farm in Britain, they look awfully like the people, in terms of relative income, who farm in the United States. The fact that the Queen is the largest farmer sort of adds to the complexity of the issue, but that's a different issue. What is so obvious is when we make direct payments, and that's the single farm payment, it is transparently obvious what it is. It's an income transfer. As such, when it becomes clear that most of those monies are going to people who are not in need of welfare, who are not a single mother raising 2 children in Detroit, or, if you like, Liverpool, roughly the Detroit equivalent. I didn't grow up in Liverpool, so I'm rude about Liverpool. Then it becomes transparently obvious. In fact, there is a heavy push among the insurance industry and some farm groups in Europe to shift that single farm payment or a substantial amount of it into agricultural insurance, because then it looks as though you're only helping farmers when they need help. And you'll hear that from the crop insurance talking points that came out a few days ago in relation to the farm lobbying. You'll hear that from the Farm Bureau, and particularly the corn growers. These are guys that say this a lot. But behind all of that, it's, can we please maintain our subsidies? And that's a big part of what's going on. So the risk with these transparent payments is that they'll go away, just as the direct payments program was going to go away. Those
2000, 2002.
But in 2011, the super committee dealing with budget deficit explicitly told the agricultural committees, you either get rid of the direct payments program or we'll take $5 billion out of your program. If you get rid of it, we'll only take, call it $500 million or $1 billion. And that was explicitly discussed in 2011, and which is a large part of the reason why the direct payments program went away, to be replaced by
ARC PLC.
which now costs $8 billion.
Well, that'll have to be the last word. I know our experts will be here for a few minutes, and but please join me in thanking them.
Thanks, Scott. Yeah.
That was
Easy.
Yeah, well.
I didn't want to get in your way. You guys
No, well,
doing much better
you
job
guys
than I
have
would.
done a lot of